Hello, everyone. Uh, we're going to cover a little bit today on what's known as dollar cost averaging. So, this is a concept that investment advisors talk about to help people take advantage of ups and downs in the marketplace over time. And we're going to use chickens as our tool to help explain this. So, on the board here, I have a graphic representation of what we often think about in the stock market, that over a long period of time, it goes up, but you have some downs in between. And sometimes those down periods are short, short and small, like those two there. And sometimes they're big. They're big ones like the stock market crashes that we've seen over and over. In fact, one recently due to COVID. And those can be quite devastating to someone's financial plan if they need that money right during that time. But what advisors will often say is if you're concerned about volatility in the marketplace, and you should be, because that's one of the things that we don't control, is to dollar cost average, which means putting in money frequently over time, and that tends to statistically have a better outcome. So it doesn't always make sense to people why that's the case. So take a look at if you were a farmer and you wanted to buy chickens for your farm, and chickens were $10 a piece, and you had $300, you could buy 30 chickens for your $300, and hopefully the price of chickens would go up by the time that you wanted to sell them. But let's say that the market's volatile for chickens. So in the first month, you've got use $100 and you buy 10 chickens. Okay, so that's chickens that are $10. Now in the next month, the market for chickens goes down, so they are $5 a piece. How many chickens are you able to buy with your $100 then? 20 chickens. So now you got 30 chickens. The next month, the market goes back up to $10 for chickens, and you buy 10 more chickens. So over 3 months, how many chickens have you purchased? 40. 10 the first month, 20 the second month, and 10 in the third month. Now compare that to having bought 30 chickens right off the bat. So you actually have 10 more chickens simply by buying over time. In fact, you've had a 30% rate of return on your investment by doing that. So that's how dollar cost averaging works, is we buy as it's going up, and we also buy in the periods when it's down. And over a long period of time, it does work out that you tend to have a better return on your investment through that dollar cost averaging. So if you are sitting with some money ready to invest right now, and you're concerned about the volatility in the marketplace, and we don't know what's going to happen with COVID, the US election, the economic recoveries, all the things that are going on, the trade war with China, everything that's going on in the marketplace right now, what I would suggest is you consider dollar cost averaging. Take a certain percentage of what you have right now and invest that every month going forward. Take the emotion out of it. Just move forward with that. Think about the chickens. I hope that analogy makes sense to everyone, and looking forward to presenting again very soon.